the #1 Costa Rica real estate and investment podcast, bringing you experts from all over Costa Rica.
Good morning, guys, and welcome to episode 250 of Costa Rica Real Estate and Investments with me, your host, Richard Bexon. Today, actually coming to you from the beach, so excuse that maybe the voice quality is not as good as normal as it has been in the previous podcasts. But as many of you know, we have a 6-villa development that quite a few of you have actually invested into. Actually, a few of you actually bought villas in the development as well. And, you know, things are going, I always say, things are going too well. I think we have quite a few reservations on the books already, and we're not even finished. So I'm here keeping an eye on that here for the next coming weeks. We finished that project in July. I'm very excited to kind of launch that, first with 3 treehouse villas in Mount Antonio, and then another 3 kind of later on in the year as well as us planning basically our next development, which is up in Aranjel as well. That's currently in construction documents to do 6 beautiful villas on a ridgeline, kind of Bali style up there, and maybe another 10 to 12 villas there as well. So if anyone's interested in getting involved in that or would like to know more, guys, no obligation. In the description down below, you'll find a link there. You can chat with Jake or Anna in our office, or you can email me, info@investingcostarica.com. That's info@investingcostarica.com. I also know that they're doing some fractional investments, shared kind of ownership, as well as doing some tokenization as well for some smaller investments there as well. Jake in the office wanted to basically tokenize kind of things a little bit, so you could buy kind of smaller fractions of it and get in kind of, I suppose, invest with us. It's very interesting what we do. And if you're interested in doing that, just click the link down below and we can kind of chat about that. But anyway, today we're going to be talking with Alex McGawan. We've had him on the podcast before. He's a CPA and owner of McGowan Tax, a US company that focuses on tax for expats, mainly, again, people in the US. It's a very confusing and I'd say difficult thing to kind of manage. So we're going to be going kind of a little bit more into details on managing foreign income, deferring expenses, etc., and kind of just seeing how the IRS looks at this. But yeah, let's get straight into it. Good morning, Alex. How you doing?
Hey, Richard, doing great. How are you?
Good. I know you were in Costa Rica last week and we weren't able to connect as I'm here in Mount Antonio. But yeah, how was it?
Yeah, that was my first trip really outside of Guanacaste, which was cool, just because I've spent a lot of time in Guanacaste in the past. So that was a good, different change of scenery, like seeing some of the mountains. And I took I guess I flew to Liberia and
Yep.
then and then I was in Guanacaste for a couple of days. And then I took the Sansa flight
Yep.
across, which was cool because then you kind of got to see all the jungle and everything along the way. But yeah, it was fun.
I think I must be one of Sansa's biggest clients, to be honest with you. So I fly constantly with them. But it's
I'm
definitely,
glad I did it.
yeah.
Yeah.
You saved yourself a lot of time.
Yeah, it was a lot cheaper. And then whenever I'm in Costa Rica, for some reason, I tend to make long drives twice as long as they're supposed to be. I'm not sure why.
Okay.
I have a knack for going the wrong direction sometimes. But yeah, so got me there.
Awesome.
Nice.
Well, let's get straight into the podcast here because I know that we've got some interesting questions. But I mean, volatility continues to happen. I don't think that that's going away. Market goes up, market goes down, and just politically, I said the world economics is pretty, and politics is pretty unstable at the moment. But what are you seeing? I mean, because again, you have clients here in Costa Rica, a lot of your business, but what are you seeing happening here in Costa Rica? And also, how has this impacted your workload? I'm trying to give the listeners an idea of look, I am busier than I've ever been, or no, I'm not,
Yeah.
So yeah.
Yeah, I mean, I've been working with clients in or investing in Costa Rica now for several years, and I feel like as far as the amount of American investment from my perspective, that hasn't really changed, or I haven't seen a downtick in it. I will say it's been a little different. I think there were more expats several years
Yep.
ago, like people actually moving there and investing and living there. Now I'm kind of seeing more just investment in, say, rental properties or investment properties down there, and maybe part-time vacation type investments down in Costa Rica. And that could just be a result of less like the economics going on in Costa Rica and more just my client base, but that's what I've been seeing.
Awesome.
Yeah.
Well, let's get into some of the details here because again, I know I'll probably anyone that's listened or read the description for this, it's going to be about tax. But
Yeah.
I mean, I think I know the answer to this question, but I'm going to ask it anyway. But like, if as a US citizen, do they need to report their Costa Rican property or business interest to the IRS?
Yeah. So I mean, yeah, that's step one from a compliance standpoint is just understanding this worldwide tax system that the US tax system has. If you're a US citizen or a US tax resident, meaning you're living there, or have a green card, then you have to report your worldwide assets. So if you invest in a Costa Rican property, um, that's reportable if it's producing income. So if it's a rental property, then that's going to be reportable to the US. If you just invest directly in real estate and you just hold it, say you have a second home down there, there's nothing to report to the US actually, if it's in
Okay.
your personal name. Where it starts to get tricky with the reporting is when you start setting up companies in Costa Rica, you have bank accounts in Costa Rica, and of course when there's a business activity through those investments.
So, I mean, I think I understand like if you have a vacation rental down here as kind of an investment, you need to report that to the IRS. But I mean, if you're living down here, you have residency, you have your house down here. But the moment you open a bank account, you now have to report that bank account and the money that's in it to the IRS.
Correct. Well, there's a threshold limit. So there's a
Okay.
$10,000 limit. So once you hit 10,000 US dollars, so then you have to report that on what's called an FBAR, a foreign bank account report, to the IRS. And
Okay.
the way that calculation's done is it's in aggregate. So like if you have three Costa Rican bank accounts and one of them has the equivalent of $11,000 and two of them have zero, you have
Yep.
to report all three of them because in aggregate it's
Yep.
or you add them together. If you have two accounts with 6,000, you would add them together. You're over 10,000, you have to report it. So yeah, that's how that works. And there's no tax associated with it. It's not that big of a deal to do it.
Yep.
People like me can do it. I show a lot of my clients how to do it online because it doesn't take, a rocket scientist. It's more just knowing you have the reporting responsibility because the penalty can be high. It's technically $10,000 per year per missed.
Wow.
So you can very easily start getting to penalties that are more than the value of the accounts,
Well,
which is a little ridiculous, but
yeah, I mean, but also, I've been opening accounts here recently, and some of my investors or shareholders in this stuff are actually U.S. citizens, and I have to fill out an IRS form here. When opening a corporation bank account here, and they want to know, the shareholders, their names, their social security numbers, etc. So it's being reported.
right. And that's a good point. I mean, there's really two sides to the foreign bank account report or the Costa Rican bank account reporting. One is the reason all this came up is under what happened under FATCA, the Foreign Account Tax Compliance Act back in 2000, I forget, 11, 12, or 2010 actually. Um, and what they did, the IRS basically blackmailed the rest of the world. These are my words, but blackmailed the rest of the world's banking system to say, you're going to turn over all of your US account holders to us, the IRS, or we're going to charge you a 30% tax on any transaction with the US financial system. So most
Yep.
banks, Costa Rica being one of them, signed up. And so to do that, now they want to know, they have to put in a form to ask if you're a US person when you sign up. Sometimes that makes them say, we don't actually want you. That's too much paperwork, and they kick you out. I haven't been
Yep.
seeing that as much in Costa
No, I
Rica
haven't seen that.
as I've seen in other countries. But so the financial system or the bank in Costa Rica has to file a report with the IRS or the US Treasury to disclose the US account holders and their financial accounts.
Yeah. Yeah.
We're doing the same thing on your side to the IRS.
Well, they're
The
just
IRS
checking, right?
well, they should be, but they actually haven't figured out how to match the two yet. So there's no, like I said earlier, there's a $10,000 penalty. In my experience, it's extremely unlikely that I mean, just being honest, that you're going to get caught,
Yeah. Yeah.
as of now. But I feel like they're so close to being able to match those things that it's really just a matter of time. And the problem is that just the format of the information the bank sends is different enough from the format that you send in to make it complicated
Yeah.
to match it up, basically, is the
Well, I
problem.
mean, I'm sure AI could probably do it pretty quickly if that makes sense. So
Exactly.
that's the thing I
The
think,
funding question at the end of the day.
correct. Yeah.
Right? It's
Yeah.
just when do they have the money to invest in the technology to do it?
That's
And
it.
is it worth it from a investment
That's
versus financial
Yep.
benefit? And so at some point they're going to make that decision.
I mean, I think we've talked at like a government level here, but what about at a state level? Are there any tax implications people should be aware of?
Yeah, so I mean, I'd put at a state level two different camps really. One is your people that are staying in the US and staying in their state. Then nothing really changes. If you invest in Costa Rica, you have uh the F bar and the foreign bank account reporting, that's strictly a federal thing. That's not a
Yep.
state thing at all. But from an income perspective, you're going to report your worldwide income to the state that you're a resident in. So that doesn't really change. If you have rental income or capital gain in Costa Rica, you're going to need to report that at the state level. Federally, if you're living in that state, federally, you get a credit for income taxes you pay in Costa Rica for in on your federal tax return. At a state level, that may or may not be true, depending on what state you live in. For example, Maryland does not allow the foreign tax credit. California is tricky as all. California is always tricky and
Yep.
and expensive. New York doesn't allow foreign tax credit, so it really just depends what state you're in. You have to look at the specific rules. But then the other side of the coin is if you actually move and live in Costa Rica, I'm generally helping my clients make sure they break residency in whatever state they were in,
Yep.
so that there's no longer any state tax reporting. You can get in a weird situation where, like, if you're intentionally going to Costa Rica temporarily. So if it's like you're saying, I'm going to move, to Manuel Antonio for 1 year, and then we're going back to Idaho, you're going to continue to be an Idaho resident under their domicile rules for even for that year. But otherwise, we're breaking residency and losing a taxing jurisdiction if you're moving to
Yeah.
Costa Rica. That's the goal.
What are the best states to be a resident of then, if you have a Costa Rica, if you have it foreign income?
Um, Generally the non-taxable ones, I mean, so that's going to be Florida, Texas, Nevada, Washington, South Dakota. These I'm probably leaving out a couple, but those are your non-tax states, at least no income tax.
Yep.
So those are generally the best. And then other than that, I guess I define it more by what's the worst, and it is kind of what you'd expect. California, Illinois, New York, those are the ones that have the highest rates, and they have, they're more complex in their
Yeah.
administration. You know, so yeah.
So, I was with an investor the other day. He was looking at property down here, with me to do another investment. He was taking pictures, of everything going on, getting bills for everything. He already has a company here in Costa Rica. And I think that what he was doing was showing evidence in order to be able to maximize some form of deductions he has, that
Right.
he can deduct his travel, he can deduct his expenses while he's down here, while he's looking for his next investment. I don't
Right.
know whether that was the right way to do it or what he was doing, but like, how do you maximize your deductions, in the US on Costa Rican real estate investments, vacation rentals?
Yeah, yeah. Yeah, I mean, um, the first step with deductions is making sure you have a trader business. So, if it's a passive investment, like if you invest in, a company in Costa Rica, or the goal, like you invest in a development project, um, it's harder to deduct things in that case because there's not really a business. You don't have a trader business personally in that state. I mean, in Costa Rica, or relative to that income. Rental income is different because that is a trader business that's going on. So there we can deduct things that are ordinary and necessary. So there's the typical expenses, like if you have a rental property, um, you know, utilities, if you're paying interest on a mortgage, the upkeep of the
Yep.
home is going to be, obviously deductible. But travel is a big one that people leave out a lot of times, and it's tricky the way the IRS defines the travel expenses. So, technically, to deduct a travel expense, the primary purpose of the trip to Costa Rica would need to be related to that business activity, so that rental property. So as long as the primary purpose is that, then you can deduct all of the travel expense. So all of your airfare can be done, and the rental car, that can all be deducted against that activity. And your stay can be deductible towards the percentage that's related to the business. So,
Yeah.
like,
Yeah.
as an example, and where it gets tricky, obviously, is determining what was the primary purpose. And
Yeah.
that's probably what your client was doing. Like what I tell my clients, I have kind of a workbook I give people to document what they're doing each day. And
Yep.
it's not done by like hours, because like if you go to Costa Rica for a week and you're going to meet and look at investment properties and things like that, or maybe just check on an investment property you have and restock things, buy things. It's not that you necessarily have to spend more time doing that than you do like a leisure activity. It's a combination of that and would you have even gone if it wasn't for the business property? You know what I mean?
Yeah. I get what you mean.
Even though you're spending more time maybe at the beach, it doesn't necessarily mean the primary purpose wasn't the business activity. But
Yeah.
what I like to do just from a safety perspective is to kind of document something. I would rather have more days documented that have some business activity
Yep.
than it's so that's probably what your client would do it was doing. What I would say is like each day document like what you did related to that business. And so it helps you to, yeah, argue that that's why you were there. You did some other
Yeah.
stuff, but that's why you were there.
And what I mean, are there any other like can you deduct anything else, depreciation, anything like that?
Yeah. I guess one thing on that travel too is there's two way like if you have an existing rental property and it's already, you're already available for rent, you're renting it out, that's where those travel expenses are directly deductible against that rental activity.
Yep.
If you're searching for properties or if you or if you found one and you're going down there to, meet with your lawyers and set up utilities and things like that, but you still have to there's still work to do. Like it's not available for rent yet and you need to, or maybe you're in the
Yep.
middle of like construction. That cost is not deductible today. It's capitalized as an additional cost of the property.
Okay.
That's where depreciation comes in. So if you purchase a property for 300,000 and you're going to spend, another 100,000 with improvements and you go down there to manage those improvements, your travel expenses in that case are added to that cost basis of, in my
Okay.
example, 400,000. And then the general rule is you can depreciate that over 30 years.
Yep.
So, and
So
that's a
it's
deduction every year,
straight line over 30 years, basically.
straight line over 30 years. And technically you have to separate the building from the land. So
Yep.
and so the land piece is actually not deductible. But
Ah,
that
so you can't depreciate the land, but you can depreciate the construction.
correct. You can
Wow.
depreciate the physical building, but not the land. So I mean, and usually it's not that straightforward to figure out what's the value of the land versus the building, unless you like bought the land and then put the building on, then it's obvious.
Yeah, yeah.
Um, but so otherwise, you take a reasonable approach to split the two.
But can you deduct food while you're here as well?
Yeah, so that's that you get a 50% deduction related to
Okay.
that.
Okay,
But
okay.
one of the things with depreciation too is there's different classes. So like the building is a 30% class. So that's straight line over 30 years. But things like furniture and
Like fixtures and
equipment,
fittings. Yeah.
fixtures and fittings, that can be 5 or 7 years. So one thing you can look into is what's called a cost segregation study to, I guess the simple way is just to say, all right, my building, I spent 300,000 of it. Let's say 10% is the land. So we're going to say 270 is,
Yep.
depreciable over 30 years. Well, you can take that 270 and then say, all right, well, I spent, you know, another 50,000 on fixtures and fittings, and you can break that out. And then that's a 7-year property. So that's boosting
Okay.
your deduction on the front end. What you
Yeah.
don't get that a lot of US people get tripped up by is bonus depreciation.
Yep.
So in the US, the cost segregation study is a lot more valuable for a US property because when you start breaking it out into these 5, 7 year property, you can deduct 100. Well, today it's actually 60% of that. And again, also the other thing about this is that this is one of the areas that the rules change like every year with depreciation. And this is kind of a hot year. Obviously, we're in the middle of a tax reform or tax extension package now that the House has passed, and we're waiting to see what the Senate does. But yeah, depreciation is a big one. The rules change a lot, but the more we can get to lower depreciation numbers, the better.
Yeah, no, I agree. I agree. Let's talk capital gains a little bit here as well, because again, from what I understood, and again, this is what I understand. I mean, if you make a gain outside of the if outside the US and you like then don't repatriate it back, but you continue to invest it, it's not taxable at capital gains in the US. Is that correct or not?
Like if there's an actual sale that
Well, I mean,
triggers.
I bought something for, I don't know, 500,000. 5 years later, I sell it for 1 million. Okay. There's been a gain, probably a little bit more because depreciation, but say that
Right.
gain that I have, if I now go and buy another property for 1 million in Costa Rica, I don't need to, there's no taxable event on that gain, if that makes sense in the US at the moment.
Uh,
Or is that wrong?
well, it's possible you can get there. It doesn't automatically
Okay.
happen like that.
Okay.
I
Okay.
guess is the point. So you can,
Because you
uh,
can keep rolling it in the US, right? You can just roll
right.
it
It's
from.
called, yeah, there's a like kind exchange or a section
Yep.
1031 exchange where in the US you can defer the gain on business property that's of a like kind. So for example, investment property, rental properties, yes, you can sell those. And in your example, if you have this gain, you can turn around and purchase another investment property and roll that gain into the other property. So,
Yep.
I mean, a simple example how that would work is if you purchase a property for 100,000, it goes up in value to 300. You sell it, make a $200,000 gain, and then you go buy another property for 300,000.
Yep.
You now have to reduce your basis in that property by the 200 gain with that you forewent, if that's a word.
Yeah, I mean, you're deferring it, right? At
You're
some point,
deferring
you're going to have to
it
pay it at some point. You're just
at some
deferring it.
point. Exactly. But there's very specific rules for how you apply
Okay.
that like kind exchange. You have to locate the property, the replacement property within a certain amount of time. And most importantly, you have to use a qualified intermediary in the US, meaning you can't personally like sell that property, take the money and go buy another property. You have to sell that property. It has to go into escrow with a qualified
Mm,
intermediary that
okay.
you've
Okay.
connected with on the front end. They hold the money and they purchase the replacement property.
Okay. Okay. Okay.
So
Okay.
it's a very specific set of events that have to happen. So if you wait until after you've sold the property and taken the money, it's too late.
But what happens in Costa Rica? Let's say in Costa Rica that you do something like this. If you don't repatriate that money, when is there a taxable event?
If you don't repatriate it, like
I mean,
back
you
to
don't bring it back to the US. I mean, it just stays in Costa Rica, if that makes sense.
oh yeah, I mean if you sell a property and you leave it in a personal Costa Rican bank account or even a business bank account, that's realized gain in the US,
Okay.
regardless of whether you actually take it back to a US bank account or not. The US doesn't care about the repatriation aspect. The exception to that is if it's owned in a Costa Rican corporation.
Okay.
So that's where it can get a little tricky. So if you own an investment property through a Costa Rican corporation, the way it's taxed in the US depends on whether that's a controlled foreign corporation or not. So if you own 100% of it as a US person, it's a controlled foreign corporation and it triggers potential anti-deferral rules. So the whole
Okay.
that what you described was the concept of deferral. You sell it and you don't have to pay tax till you bring it back. That's the way it should work. But the IRS has certain rules when you control a foreign corporation, to where they don't allow that deferral, make you pick up the income anyway. But
Yeah.
if you own it with other Costa Ricans, or if you have it 50-50 with a non-US spouse, it's no longer a controlled foreign corporation. So it triggers that default rule, the deferred rule. So in that case, if it sits in the Costa Rican corporation, it's not taxable till you repatriate it or take it out as a dividend or
Wow.
stock. So that is a possibility, but it depends on how you're structured.
Yeah, yeah. Because I was about to ask you, like, as if I have a vacation rental down here investment property, is it better for me to hold it in my name or is it better for me to hold it in a corporation?
Yeah, I mean, I generally say in your name or in a corporation. Even if it's in a corporation, I do what's called an entity classification election to make it a flow through. So one
Okay.
thing to be careful of in the US is, a lot of times you're going to set up the Costa Rican equivalent of an LLC, the SRL or Limitada,
Yep.
and the US is going to treat that as a foreign corporation, even though, like in my mind, or if you're a US person is going to think an LLC defaults to a flow through in the US. It doesn't default to that in Costa Rica. So I mean, generally, I like to make the flow-through election on typical rental properties just because you get to retain the capital gain treatment. So the problem with selling it, keeping it a foreign corporation, is that you may be able to defer the gain on the sale, and that only happens if it's even if it's a controlled foreign corporation, if you pay more than like a 20% tax, actually 19% tax in Costa Rica on the gain, which I think you would in most cases.
No, actually, capital gains in Costa Rica is 15%.
Okay. So in that case, it's going to trigger the anti-deferral rule. So you don't get the
Yep.
deferral and then you get taxed at ordinary rates. So two bad answers. So whereas if you had the flow through, it's going to be taxed at capital gains, which is going to give you, in some cases, half the tax rate. So it's a much better answer. So I like the flow through holding it directly model unless we can get out of the controlled foreign corporation rule. So
Yeah.
50% spouse, Costa Rican investor, some way it's not a US controlled foreign corporation.
Interesting. And a flow through basis just means that all basically income and expenses flow up to a US corp or flow up to you personally in the US.
Right. Whoever owns it in the US. So if you own it personally in the US, it's going to flow up to you, the annual income and expenses, but also the annual Costa Rican tax. So, I mean, if it's a rental property and you make, $10,000 on that property, you'll take a credit for the Costa Rican taxes paid.
Yep.
So you'll pay the higher of the two at the end of the day. So,
oh, wow. Okay. So you pay the higher of the two taxes?
Correct. Yeah.
Wow. I think Costa Rica probably tax rate might be a little higher than the US, depending on how much your revenue is.
Probably so. Yeah, that's been my experience. So in a lot of cases, plus when you factor in the depreciation we mentioned, in a lot of cases there's not any income, especially rental. So I like the flow through model personally, and it's just important people know that doesn't happen automatically either. You need to make the election technically within 75 days, but yeah, it's fun stuff. They don't make it easy.
No, well, I mean, look, if they made it easy, they wouldn't need you, Alex. So, but I always say that, if it was easy, everyone would be doing it. And I mean, I suppose, that applies to most things. And, because people are like, Rich, I don't know, I was talking to someone the other day. They were like, Rich, do you realize how much more money you could be making if you were in the US or, in the UK developing or Europe? And I'm like, yeah, but it's not as fun, man. Like I get to, build cool stuff down here and work with amazing people, and we have great investors, so.
I get to tell my wife I have to go to Costa Rica for work.
I mean, yeah, exactly, man. You do deduct those travel expenses, right?
Oh yeah, for sure.
Okay.
I know the rules. I'm
that's true. True. Well, Alex, this has been great, man. I mean, I could go down the rabbit hole with you, and I'm sure that there's probably more, questions here from people listening here. So I'll put all your contact details in the description. But my last question for you, Alex, which is one that I love to ask, every single time, and I'm not too sure. I don't remember what your last answer was, but it kind of changes every single time. Sometimes, that I speak to people. But if you inherited $500,000 and you had to invest it into a business or real estate in Costa Rica, what would you invest it in and why?
Yeah, so I would say, I can't remember what I said before either, but now that I've seen another part of the country, like I was kind of very head set on the beach in Guanacaste.
Yep.
Now I'm really liking the jungle area and like heading out towards San Jose. So yeah, I would want, for me personally, it'd probably be like a personal place that I could go stay in Costa Rica. And so yeah, I'd like to see maybe in that Escazú area or like some like farmland out there, somewhere that's quiet, has, great weather.
Well, I mean, look, the city continues to grow out. I mean, land prices when I came to the country 20 years ago to where they are today in the Central Valley is just insane, the difference, and it keeps moving west,
right.
So, I mean, I think farmland out there, you'd probably do pretty well with. And again, we have great infrastructure here in the, the Central Valley, or I'm not there in the Central Valley. I live there, but I mean, that's a very interesting one because we've got a lot of people looking at like San Ramon and Grecia and even Ciudad Colón, Escazú at the moment as investments, because also is, and we see a lot of development, a lot of free trade zones moving out there as well from people from the US, and like all this foreign direct investment that's not happening at the beach is happening in these areas.
Right. Yeah, no, I really enjoyed that area, and it's closer to the beach than I thought. Like, I mean, you can get to Jaco in an hour and a half from where I was, so it's a really cool spot. I think that's where I'd be looking.
Awesome, man. Well, Alex, it's been an absolute pleasure. Thank you very much for sharing all of your knowledge with us. And anyone that wants to get in contact with Alex, I'll put all of his contact details in the description. But very much appreciate it, sir.
All right, thanks, Richard. Appreciate it.
No worries. Have a good one. I hope you enjoyed that podcast there with Alex, guys. As you can see, I don't know if it got a little too more technical for a lot of you guys, but if you want to chat with him, feel free to. I think with any US citizens, you've got to be careful with the IRS and kind of declare a lot of stuff. Uncle Sam, I suppose, is always watching. And you just never know. But again, if you want to chat with Alex about investing or the best way to structure stuff here in Costa Rica, I suggest that you do. It could be before or after you invest in assets here, just to make sure that the structure that you're using is correct as well. But anyway, guys, if you enjoyed the podcast, please give us a thumbs up, 5 stars. It's great to hear from some of you actually writing comments and also emailing us. Anything you need in Costa Rica, guys, we're suckers for helping people. So just let us know. Again, you can contact us, info@investingcostarica.com. That's info@investingcostarica.com. But till the next podcast, we'll see you soon. Bye. Good afternoon, guys, and welcome to episode 248 of Costa Rica Real Estate and Investments with me, your host, Richard Beckson. Today, we're going to be talking with Paulo Rantana. She's been on the podcast a couple of times before. She is a lawyer and also partner at Legal She. So we're going to be talking to her today about how real estate deals go wrong and what you can do to make sure that they don't, because often they actually do, guys. So we're just going to go through some of the details there, things to be wary of, questions you should ask. And as I always say, trust but verify everything. But yeah, if you're looking to do anything in Costa Rica, guys, we're actually helping a lot of you out at the moment, whether that's just kind of giving you advice on something you're looking to invest here or something to buy, an Airbnb. We've had some of you basically looking to develop land, invest in new projects, hotels. We do actually project manage a lot of developments and builds here in Costa Rica as well as develop and build ourselves. We have some investment opportunities starting at $100,000 here in Costa Rica in Manuel Antonio and Aranjel. Very exciting. These projects are underway at the moment, due to be finished, one in August and one in December here. Actually, we have reservations on the books, if you can believe it. Absolutely nuts. But I think we have about $200,000 of reservations on the books, and we haven't even finished construction yet. But it's what makes these developments very unique is, again, we're able to leverage our whole network here. And as many of you know, I used to own the country's largest luxury travel company. So connecting into that is very, very easy. I often feel like I'm cheating. But anyway, you can email us info@investingcostarica.com. That's info@investingcostarica.com, or in the description down below is all of our contact details. But let's get straight into the podcast.